longing the stock just before you got it, ex dividend date. That's how you get best of both the worlds. I was telling you that on this channel, you're gonna get the top shelf information. Let me tell you about the next step, and I'm just getting started. Hi everybody, welcome to the video. Today I'm going to improve on your trading if you do a lot of hedging. You're gonna learn something really solid, no doubt about this. Zero cost collar, rent, plus safety without paying a single penny. How the zero loss collar is created, you are going to learn that. Not only that, we're gonna take it up the notch, where I'm gonna tell you things, nitty-gritties of it, how to really make it really powerful when you trade this in stock and index. And obviously we're going to talk about the weakness of it as well, around 360 degrees, step by step. Gonna be beautiful. You're gonna learn a lot of things. Zero cost collar in a nutshell before we go advanced. So let me tell you exactly what we are talking about and why do we call it zero cost collar. What you see here is an option chain. It's a monthly Nifty option chain. It can be anything, any stock, it does not matter. First thing we're going to do is we are going to long a future. So here we have noted down the price. Current future May series is trading at 23,953. Okay, this is step number one. It's very easy. Now, obviously, if we just long future without any protection, if market starts to crash, then it's going to be a total nightmare. We're not going to do it. We're going to make it zero cost. Step number two, we will buy a put, which is around at the money. 24,000 put if we buy, which is trading at 463. At the money put which we buy, everybody knows this. This is what it is. It is trading at 463 approximately. Long the future, long the put. So on the downside, we are fully protected. But now when you long this put, this is the cost going out of your pocket. This 463 multiplied by lot size is the actual cost of hedging your future. This is really heavy, high. So now we have to make it zero cost. How do we make it zero cost? Is that this is a debit of 463. We will sell calls. So we will collect equal amount of credit so that it net becomes a zero cost collar. So naturally we're going to go out of the money and we look to sell one call or two calls max. So we have a zero cost collar. We have it in place. And this is exactly what we did. 24,200 call of May we sold, which is trading at 325. We collected the credit. When you buy, you give it. When you sell, you collect the credit, right? So debit has to be equal to credit. And then we are selling one more call out of the money, which is trading at 146. So net cost of selling the calls is how much? It's very simple. It's 325 plus 146. This happens to be 471 is the net credit which we got after selling the calls. The cost of buying the put is how much? 463. And don't worry, as soon as you long future and you buy put, your margin is going to go super down. Clear? Now, before I go advance on this, I want to tell you certain things because these kind of strategy nobody talks about. Now, when we make a zero cost collar, Nifty can really crash. It's 23,900. It can go down 900 points. It can become 23,000, right? If it becomes 23, then this put is in the money by 1,000 points. Simple calculation, intrinsic value of 1,000. The calls are going to be zero. So if market crash, when we make a zero cost collar, we understand that we are long in the future. But if market starts to crash, in that situation, we are making approximately 3,900. Now, what if market really crash and go to 22,000? What is going to happen? So 22,000. This put which we bought is going to be 2,000. And then obviously the calls are going to be zero, as you know. So if market crash, and you do absolutely nothing with your trade, 3,900 is up for grabs. You are totally hedged. You're going to have a complete peace of mind when you trade something like this. I'm going to make it even better. We will make it very deadly. But once I have your basics in place. Now, what if market go up? If market go up in that situation, suppose if market go and touches your first call, which is 24,200, obviously future will make money. Put out of the money we know becomes zero and everything else becomes zero. This is the best situation. We stand to make around 18,900 if market shoot up. This is without any adjustment, without anything. right? So this is how we create a zero cost collar. But how to make it even deadlier and how pro use the information which is not available publicly, now I'm going to tell you. Ready for it? Let's cover it each one by one. Number one is smart play dividend on steroids. How to use it effectively for a dividend play. That's correct. Collar. Suppose if you pick a stock just before the X dividend date. For example, a stock which pay dividends. Regular retail people just simply hold the stock and they have a hope that they're gonna get the dividend and stock is gonna go up. What happens before the dividend? Stock can really go down. What we can do is we want to take advantage of both the worlds very smartly. We long the stock just before the X dividend date, right? That is in our portfolio. And immediately we make a collar. We buy the put, we sell the call. If you want, you can sell one or two calls. That completely depends on you, that how much is the costing of the put. It all depends on that. What will happen in the future? You're still holding the stock, maybe HDFC Bank or Reliance or whatever your favorite stock. You got the dividend from the stock. You got the income from the call which you sold. Your downside is protected. Even if stock go down by 20%, even then you are protected. You're welcome. Let me show you what do I mean. So here the only change is going to happen that I'm showing you Nifty example. Instead of Nifty, you are just longing a stock, but you are not longing any other stock. Just like that, you are longing the stock just before you got it, X dividend date. That's how you get best of both the worlds. I was telling you that on this channel, you're gonna get the top shelf information. Let me tell you about the next step, and I'm just getting started. Trick number 2, before major news and events. Here is an example. RBI is about to announce a major news tomorrow or whatever, right? A big event is coming, can be anything, even in US markets. Now, everyone is panicking. What do? We simply long the future of or a stock or whatever, does not matter. We long the put and we short the call. What happens before the event? Everybody know this. IVs really go up. What do people do is that is simply just sell a straddle on us or a strangle. One gap down and then gone again. I mean, this is not the right way to trade. We can do a protective collar just like that, and we can make it zero cost like I showed you. After the event, if Nifty really go down 500 points and surprise and chaos in the market. Chaos in the market does not mean chaos in our portfolio, right? If market go up, then we can always cover our positions because you're already long in the future. Much better way to trade and hedge your positions. Remember, it's much better to sell the call when the IVs of the call is higher. I'm going to tell you more about this, don't worry. Time for VIP points. Now, it's better for trading stock. Reason, now obviously, like I say, half knowledge is completely dangerous. So don't take half. I want to give you as much knowledge as I can. On YouTube, I have limitations as you know it. If you're really serious about option trading and you want to learn the top shelf trading methods, style, and strategy, you can always get in touch with the team and get all details about the learning support. Team is there to guide you, will help you out. Okay, it's better for stocks. Why? Now in stocks, now a lot of people may say that you are longing in the future and you're buying the put, and why don't we do synthetic future? So instead of that, why do we? Let me tell you, this is going to work in the future. In stock, you cannot go synthetic because when you long future will have liquidity. Any blue chip stock, if you're buying the put, that will have liquidity. So do not try to make a synthetic future and then you long. You can do it in the future, but in stocks, this covered collar works really well because of liquidity issue which stocks have. Okay, futures have no issue of liquidity in stocks, but options in the money have some liquidity issues. That is the reason, because a lot of people will say that longing future, longing put, why don't we simply sell a call? What's going to happen in that situation? Is that going to work? IVs play very important role. Please make a good note of this. When you long the future and when you long the put, that behaves differently under different IV conditions, because IV have no effect on the future pricing, wherein the put IVs can really soar up. Obviously, this information you're only gonna get when you trade for years into the market. You don't need to give that much stop loss to the market to learn from the market. I'm telling you beforehand, you can always do it. Trading doesn't have to be gamble. Trading has to be like a proper business. Every business has the methods, techniques, which is very easy to learn, just like you're learning right now. Works even better when IVs are high. When the call IVs are high, Zero cost collar works the best, really a killer of the method which you can do. This is an additional tips which I'm giving you. Collar strategy is over. I could have ended the video, but there are a lot of full-time traders who watch my videos because these are of advanced level. We touch the basic and we scratch the surface, the advanced surface as well. Not ideal for scalping. Now this has limitations, so if you think to do it intraday, etc., it's not going to work. Not for scalping. No profit in flat market. If market remains flat, this is not a holy grail. And by the way, I haven't even touched the adjustments. If I start talking about the adjustments of this, it's gonna be blockbuster, and I will need some time, at least 10-15 minutes to teach you. But I must tell you, in a flat market, this is not really effective. We can't get best of both the worlds, isn't it? Want to learn how to roll? Now, for adjustments, if you want to learn how to roll the calls, when to roll the calls, how to slash your trade, can you go in the money instead of at the money put? What benefits you're going to have when you go in the money? If you want to learn all about that, you can type it in the comment section. Let me see if there is demand for people who want to learn these techniques, and nobody discuss about zero cost collar, of course. So if you want to learn this, let me know. Probably I'll make a second part of this where I'm going to tell you how to slash your trade, how you can make it even better when you do in the money. I'm sure you must have liked when I told you that how you can get dividends in the stock very smartly, right? Buy just before it, and that's how you can long it. You have to long it anyways, the stock. Why don't you cover it properly and hedge it? Much intelligent, much better way to trade. That's the reason why I say hit and trial way of trading one must avoid completely. Elevate your trading game, learn the craft in record time, get in touch to learn in depth. Just drop a message, you can get details directly from the team. Option trading is a game of skill, it's a game of intelligence, and it's a craft. If you treat it like a business, this is gonna give you returns like a proper business. That's it from me today. I'm sure you must have learned something really good. Thanks for watching, and like I always say, you are going to do so well in trading, you will surprise everyone. I wish you all the best. Bye-bye.